Hi guys, welcome back. Altria is one of the highest paying dividend stocks in the S&P 500 with a yield over 6%. Despite a shrinking smoking market and rising regulations, it still managed to deliver over 40% total returns in the last 12 months, crushing the broader market. For dividend investors, that is hard to ignore. But how sustainable is this income stream really? In this video, I will break down the numbers, the risks, and why Altria remains a favorite pick for income-focused investors. And of course, we will also see how they rank in my stock scoring system. And if you're new here, my name is Florian. Thank you for joining me today. So, Altria is with a yield of 6.4%, one of the highest yielding dividend stocks in the S&P 500 and one of the most favorite stocks for many dividend investors, as Kiplinger shows in this recent article from beginning of October. And in the last 12 months, investors could be quite happy with the performance of the stock. While the S&P 500 returned 14.9% during this time, Altria had a total performance of close to 40%. This total performance, of course, also includes the dividends. But over the last 10 years, the picture looks a bit different. While the S&P 500 returned close to 300% in the last decade, the total performance of Altria was only a bit over 100% here. So, while their recent performance was actually pretty good, they have not been a good long-term investment, despite their reputation as dividend darling. But before we dive into the background of this, let's first briefly check what exactly they are doing. And I'll keep this very short this time, because I think that most people watching this probably already know Altria. The Altria Group is one of the world's largest tobacco and nicotine companies in the world. The headquarters is in Richmond, Virginia, and their roots date back to Philip Morris, which was founded in the 1800s. Their core business remains smokable products like cigarettes, with brands like Marlboro, L&M or Chesterfield. But they are shifting their focus more and more to smokeless products with their subsidiaries that include vapes like the Enjoy brand or nicotine pouches like On or Copenhagen. In fact, they are currently making huge efforts to switch to a more smokeless portfolio. And there are good reasons for this. Because from one side, the regulatory pressure on cigarettes and other smokable products is rising. For example, just earlier this year, the FDA proposed a new rule that would significantly limit the nicotine level in combusted tobacco products like cigarettes in order to lower the addiction potential for them. And on the other hand, the trend to tobacco use has been going down for years now. This is nothing new, and although the forecast actually shows that the biggest decline might be behind us now, and the numbers won't shrink as much as they did, the trend is still pointing down all over the world. And these numbers include all tobacco products, including smokeless products. And in fact, by far the most tobacco users still smoke cigarettes, while only a relatively small number uses smokeless products. I tried to dig a bit deeper into the numbers to find out the rough percentage of users of smokeless products compared to combustible tobacco products. But unfortunately, what I found is not 100% clear. The best that I could find is this report from the World Health Organization, but what they categorize as smokeless here also includes dual-use products that can be used as smokeless as well as smokables. But even when we include these dual-use products, this user group is with only 7% overall still pretty low. So the number of people using nicotine products in general is going down and down, even if we include newer products that are marketed as better and more healthy alternatives. But what is surprising is that the market itself is still growing. Until 2030, the market is expected to grow by around 3.5% overall. These are the numbers for the US market, which is the main market for Altria, but the trend also looks pretty similar when we look at the worldwide market trends. And this growth also includes combustibles as well as smokeless products. So you might now ask yourself how this even works when the number of tobacco users is going down and down constantly, as we just saw. Well, the reason is actually pretty simple. The market is still growing because tobacco companies have steadily and significantly been increasing prices over the years and will continue doing so. When we only look at the smokeless tobacco market, it is even growing quicker with close to 5% growth rate every year. In this case, the growth is also due to price increases, but also the increasing amount of products as well as the increasing acceptance and use for these products, especially amongst younger people. There are different reasons for this, but in general, the WHO sees a potential shift in customer preference which is reshaping this market. And this reshaping has already begun. One example is the increasing amount of illegal vape sales without FDA clearance in the US. In 2024, for example, illegal vapes worth at least $2.4 billion have been sold in the US. Of course, the FDA is trying to prevent this and is increasing its effort here. Recently, these increased efforts are showing first fruits when the department announced their largest ever action where they confiscated 4.7 million illegal vapes with a worth of $87 million. And of course, shutting down these low-cost illegal products will help the companies that offer legal and FDA-approved alternatives like Altria's Enjoy, for example. And this is very important for them because, as I just showed you, these smokeless products are in fact the biggest growth potential they still have. It is also the part of the business that is often used as an argument for an investment in the company. But how strong is Altria here? And how much of their overall business does this even make up? To find this out, I compared the numbers from the SEC filings from Altria and their competitors. And for Altria here in red, the part of smokeless products accounts for only 14% of the total revenue. So it is by far the smaller part of the business. Philip Morris is actually very strong here with their IQOS and ZYN products. In total, smokeless products make up 41%, so almost half of their revenue already. And they are followed by British American Tobacco, where smokeless products make up 18%. Japan Tobacco and Imperial Brands are both even worse off than Altria, with only 4% for Imperial Brands and under 10% for Japan Tobacco. So even though these smokeless products are an essential part of the growth plan for them, they still only account for a smaller part of their revenue. With this in mind, it is no wonder that Altria stated in the last 10K report that they are now reassessing the smoke-free market and especially seem to shift the focus from vapes to oral products like pouches. And they also have the target to grow the EPS in the mid-single digits. And speaking of growth, when we jump into my fundamental dashboard in TradingView, we see that the revenue in the top line did not grow in the last few years. In fact, it did rather decline a little bit. But they did manage to grow their EPS as well as their net income and at least keep the free cash flow roughly stable. For my dashboard, I use the numbers from Seeking Alpha because they already calculate the growth CAGRs, so I don't have to do it myself. And Seeking Alpha uses a slightly different time frame than TradingView for their numbers, so it looks a bit different here. Still, the growth picture looks rather underwhelming. In total, they get a 5-year score of 3.3 and a 10-year score of 3.4 here. When we look at the development of only their smoke-free products again, this did indeed grow a bit, but only by a bit over 100 million last year. But interestingly enough, the volumes in their oral tobacco products, which, as we just saw, is their focus area, is going down. So the revenue increase came again only from price increases, not from more customers buying these products. And the revenue in their core segment that still generates by far the largest portion of their revenue, the smokable segment, has also been going down. So all of their bottom line growth came from price increases, which begs the question of how long they can keep doing this. Of course, their customers are literally addicted to Altria's products, so it is not so easy for them to switch or stop. But if the price becomes too high, some of these customers just won't be able to afford it anymore. But at least in the short run, these price increases even help the company to increase their margins and keep their cash flow roughly steady, while on the other hand, they barely need any more money for capex. This also enables them to use most of this cash to pay to their shareholders. And with over 8.7 billion of free cash flow, the company is still an absolute cash flow machine. Some of this money was also used to buy back shares on quite a high level, and the balance sheet of them also looks pretty decent with 1.9 net debt to EBITDA and an interest coverage ratio of 10.4 times. This stable balance sheet, together with the high and increasing margins, let them score quite high in the health and profitability category. Here, the numbers are even comparable to software business that is known for their usually quite high margins. Overall, they get a 5-year score of 9 and a 10-year score of even 9.3. And of course, Altria is also known as a high and stable dividend payer. So it is no surprise that they also get quite high scores in this category. They have a clean 10 score in yield and in dividend stability and are still above average in dividend growth and cash flow payout ratio. Overall, they get a 5-year score of 8 and a 10-year score of 7.6 here. Their clear capital allocation strategy with share buybacks, a high dividend and high ROIC, and their low customer concentration helps them to also get good score in quality. I estimated their mode as a narrow mode, which is the second best score. I think this is reasonable with their weakish position in smokeless products and the general interchangeability of smokable products from different producers. But I could also find arguments to either increase but also further decrease this. So I think 7 points for mode is a good estimation. Overall, they get a 8.5 score for 5 years and a slightly lower 8.2 score for 10 years. And because they had quite a good performance recently, they also have the momentum on their side and can gather points here. At the same time, the valuation is not too high, so they can also score here. Only the PEG ratio and the EV to EBITDA stand out here. In the case of PEG, this just shows again that the growth expectation for the next few years just isn't that big. But overall, they still get 6.4 points for 5 years and 5.7 for 10 years. When we look at the company's own 5-year valuation history though, we also see that the valuation has been quite a bit cheaper, especially in 2022 and 2023. And compared to the average valuation they had in this time, the current valuations are even around 20% higher. But when we sum this up, Altria actually doesn't get a bad overall score. In fact, it is quite a bit better than what I expected when I first started looking into them. So it is good that we have an objective and emotion-free way to rank them. Their good financial health, profitability and quality score combined with their excellent rating in dividends gives them quite a high overall score in my ranking. So last but not least, before I sum this up and come to my conclusion, let's also directly compare them to their peers. And if you find the video interesting so far, please hit the like button and subscribe to the channel. Yeah, I know, it's a bit annoying that I ask this, but it really does make a difference. And as a small thank you, I promise you to read and reply to all of your comments. So thank you very much. So for our comparison today, I chose Philip Morris, British American Tobacco, Japan Tobacco and Imperial Brands. The same companies that I also used to compare the portion of their smoke-free revenue. And from these companies, Philip Morris had the best total performance in the last 10 years, while Altria comes in at second place. But Altria pays the highest dividend from this group, which might explain their popularity with dividend investors. And at the same time, they did also manage to grow their dividends the quickest over the last 5 years, which is not a small feat with such a high yield as they have. Valuation-wise, most of these companies are on a very similar level. Only Philip Morris stands out here again with by far the highest valuation of all of these. This might be connected to the large portion of revenue from smokeless products that they have. Growth-wise, we already saw that Altria shows a very mixed picture. And the overall picture for our other companies is also pretty mixed and in many parameters even negative. Only Philip Morris again stands out here with the highest growth rates. But at least in the terms of profitability, Altria together with British American Tobacco do take the crown. So all in all, I have to say that I was a bit surprised by Altria. Yes, their market is generally decreasing even if we consider this smoke-free market. And Altria also seems to have a tough time to get a strong foothold in this important smoke-free market. So for me, it is a bit questionable if they will find their way back to growth again. But in the meanwhile, they still generate a huge amount of cash that they distribute freely amongst their investors. Their high dividend is also still covered well enough by their businesses, and a dividend growth of over 4% is nothing to scoff at when the dividend is already as high as Altria's. But let's just see how long they can keep increasing it when no new revenue is coming in. So I can definitely see why they are so interesting and popular amongst dividend investors. For people looking for a passive income, for whom growth is a secondary consideration, they do look like a nice investment. But the valuation is also a bit above the levels of the recent years, so it might be worthwhile to wait for a better entry point and lock in an even higher dividend yield than what we get today. But as always, this is just how I see it. What do you think about Altria and the tobacco market in general? Leave your thoughts down in the comments below. And guys, if you're interested in 3 companies that can benefit hugely from the trend to electrification and AI without being tech companies, check out this video right here. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.